Good day, everyone. I am Mr. Chinedu Irumba. My tutor name is Ctutors, and it's a registered academic name. Ctutors Nigeria Limited. Today I will be talking to intermediate students in accounting on the topic that said final account. Final account, just as the name goes, is final account. It is account summary of all the financial obligations or transactions that existed in a firm within a given period. So final account is of different package depending on the nature of the firm. We have sole proprietorship business, which is one-man business, a business that is established by one man and is run by one man. The liabilities are taken by one man. So everything is one man. We call it one-man business. It's a sole proprietorship. I will prepare final account for them too. And this final account always goes to your one student on WAEC level. Year one students, sole proprietorship. Then we have another final account that deals with partnership, where two or more persons are running a business with the view of exploiting the business and enjoying the profits therefrom. And that is final account of a partnership. Then we have final account of a company. So these are the three different business environments that final account is putting into consideration. So for this package, this particular tutorial, we shall be talking about final account of a sole proprietorship. So this one is for one-man business. If you're a one student or ND1 student, or you are just beginning in accounting, this topic will help you a lot. So every format, everything we are doing here is based on IFRS standard, International Financial Reporting Standard. So we shall be talking about final account in this package of a sole proprietorship. Of a sole proprietorship. Now, there are 4 stages in these accounts. 4 stages. Yes. We have stage 1, stage 2, stage 3, and stage 4. And I'm going to take this stage by stage. But first of all, I will show you the 4 stages. Then we'll now take them one after the other and see how everything goes. The only technical aspect in this final account is adjustment, additional information. Because they always give you a question, and at the end of the question, the trial balance, they will give you additional information. So you're going to make some necessary adjustments relating to previous years or some mistakes or error that occurred during the preparation of the account. So they now give it to you as additional information for you to make the necessary adjustment as at when due. So these are the areas that students find it a bit difficult to handle. But in this lesson, at the end of it, you'll be able to handle any kind of adjustment as regards final account of a sole proprietorship. Now, these are the 4 stages. The first stage is the trading stage. The trading stage. Number 2 is the profit or loss. Profit or loss stage. Number 3, we have the statement of changes in equity. And number 4 is the statement of financial position. Yes, statement of financial position, formerly known as balance sheet. Under IAS, we'll call it balance sheet. Now we're talking about IFRS. IFRS gave it a new name, statement of financial position. Before, we don't use to prepare statement of changes in equity, but it's incorporated by IFRS under the final account. So we shall be taking these accounts one after the other. The first one is the trading stage. The trading stage. Trading stage. This is where business buy and sell stock. Under this trading stage, we are talking about whatever that is happening to inventories. We're talking about inflow and outflow of inventories. Yes. So we're going to divide this stage into two parts. The first part of this trading stage is inflow of inventory. Inflow of inventories. Then the second flow of this trading stage is outflow of inventories. Outflow of inventories. Formally, we normally prepare a T account. In the T account, we put inflow of inventories on the left-hand side, and we put outflow of inventories on the right-hand side. But now we're going to present it in a statement form, according to IFRS. So that is how it flows. Now, what is inflow of inventories? Inflow of inventories is increasing the already existing inventory for already existing firms. You increase them. Like if your Bonvita is 2 packets and you think it cannot be able to sustain your customers, you have to go to the market and buy more. So when you buy more, inventory have increased. So that is inflow. And that buying effect is what we call the purchases. You purchase is inflow. Then outflow of inventories have to do with when you are selling goods to your customers. When you sell goods to your customers, the inventory will do what? To reduce, to come down. That is outflow. Another thing that will bring about outflow is when you purchase goods and some of the goods does not meet the standard of what you are doing. In that case, you have to return them back. They are called returns outward. You are returning to your suppliers. So it will reduce the inventory when you return goods to your suppliers. So these are the 2 stages. Now, what are those elements? What are those components that will come under inflow of inventories? That is what we are going to be talking about now. Components under inflow of inventories. So that when we are preparing the account, it will be easier for you to adjust. Now, under this inflow, I'm going to take it stage by stage. The first item we have to talk about is opening stock. Yes. Why am I talking about opening stock first? Opening stock is the available stock as at the time you want to start making your sales. So opening stock, number 1 is opening stock. Opening stock under inflow of inventory. Under this, we're talking about opening stock. Because whenever you open your shop, all the things you see there you are selling is called stock. They are inventories. So that is the first thing you see. That's the first item there. Now, when these inventories are not sufficient enough for you to start making sales, what you have to do is to go to the market and buy more. And that brings about the second option here, which is purchases. Purchases. You see the way I'm recording this, it has a flow. I'm taking it one after the other. The purchases should not come before opening stock. Opening stock should come before purchases. So you arrange them the way it goes. At this moment, I'm in the market, purchases. Buying things that the customers will need in my office or in my shop. Now after that, purchases, you have to carry all the things you purchased back to your shop. Now, when you're carrying all those things you purchased back to the shop, you have to make some expenses. You have to run some. There are some running costs that will attach to it. Like, even if you have your own vehicle, you need to buy fuel. Yes. So that purchase of fuel is part of these purchases. Is attached to it. If you don't have your own vehicle, you have to transport from the market to the store. So every expense is associated from transporting the goods you bought from the market to the store is what we call carriage inward. That should be number 3. Carriage inward. So if you are preparing an account under trading account in trading stage, the first thing you should put when you get to the side of inflow of inventory, I will tell you when the account start flowing. You start with opening stock. That should be your number 1. You don't have to put carriage inward on top of purchases. Arrange it very well. There's a reason for that. Now, opening stock, the next thing is add purchases. The next thing is add carriage inward. These are the things you spend in bringing the stock back to the store. So carriage inward is part of it. Number 4. Now, when you put these 3 things together, like this one is 20, for instance, this one is 20, and this one is 20. That means we're having 60. This 60 here is the available goods for sale. Available goods for sale. Now, at this point, you can only call this available goods for you if you don't have returns. If you don't have returns outward. But if you have returns outward, you have to less returns outward before you get these available goods for sale. But I'm doing this that we don't have returns outward. Now, at the end of the day, you need to know how much goods you sold, the cost of goods you sold. And for you to know the cost of goods you sold, there are some stock, there are some inventories remaining in that stock. You have to deduct those inventories before you now know the ones you have sold. So we are trying to arrive at the cost of goods sold. We're getting to the last bus stop of your inflow of inventories. So number 5 is what we call closing inventory. Just as we have opening stock, we have the closing inventory. This closing inventory is a negative. Why is it a negative? Because you have not sold them. They are still in the store. So when you deduct it from the available stock, you get you now get the cost of goods sold. Because the last bus stop under this is cost of goods sold. So when you get this figure will be compared with whatever thing you arrive at under outflow of inventory before you get what we call the gross profit. Yes. So the main purpose or the main reason for adjusting for inflow of inventories is to arrive at cost of goods sold. Whatever figure we get here should be deducted from the net figure from outflow of inventories. Under the outflow of inventories, we don't have much. Under the outflow of inventories, we have only 2 things. Number 1 is the revenue. Revenue, or you call it sales. Currently, we call it revenue, we don't call it sales. Now, revenue is all the sales made to your customers. They will be given to you inside the trial balance, you see them. So you look for revenue, you put the figure. Then, number 2, if the customers return some items after sales, then you have to bring it in. That one goes with a negative. You say returns inward. Returns inward. It will increase your inflow. Yes, it will increase the inflow. Because when you sold 10 items and the five of them are returned back, you did not sell 10 again. What you sold is actually 5. So 5 will come up again to increase your stock. So we're talking about inflow of inventories and outflow of inventories. So whenever you are working on final account under trading process, always have in mind inflow of inventories and outflow of inventories. In the next part of this, I'm going to show you how both of them flow inside a particular account. Remember that this is Ctutors Nigeria Limited. So always be on our video, always get to know what we have here. And don't forget to subscribe or to click this subscribe button so that you can get our future videos. I will see you in part 2 of this final account of a sole proprietorship.